From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. You're listening to the Macrocast. I'm Jonathan Graffeo, Managing Director with Penta, joined as always by John Fagan and Brendan Walsh from Markets Policy Partners. This week, we're also joined by Brai Odion-Esene, founder of SW4 Insights. Guys, lots of data coming out this week, lots of big decisions. The Fed, of course, raising rates again, albeit at a slower pace. We've seen coordinated moves across Europe and also some important retail and inflation data coming out. A lot to swirl around. John, you want to kick us off and help folks make sense of all this?
Yeah, thank you. It's Jonathan. It's a very consequential week. We're all tired going into year end, but no rest for the weary. And we had gotten a pretty positive kind of vibe in the last week when we saw U.S. inflation numbers, particularly the consumer price index, coming in a little bit lighter than expected, and some other indications showing real progress. This is on the back of the Fed beginning to add some nuance to its extremely hawkish policy stance that had prevailed through so much of the spring, summer, and early fall. And this was all kind of leading us into a downshift, which we were all expecting. It was from 75 basis point increments of tightening, which they did 4 successive meetings. This was a downshift, a step down, whatever you want to call it. The Fed is at pains, however, to explain that this is not a pivot, that they've still got a lot more to do. And this came through in Fed Chair Powell. Once again, he sort of seems to fluctuate, one particular meeting or set of remarks, he's a little bit more balanced. And in the other, and in this last one, he trended more on the hawkish side. And I think, this was backed up by the projection of forecasts, the so-called dot plot, where the committee members basically tried to convey the message that rates are going higher. They're going to be, 5.25, 5.5, 5, even higher than that, maybe even 6%. And they're going to stay that way all through 2023. Yeah.
And even beyond the dot plot, they raised their inflation projections for the year, but it's completely, utterly illogical. So they went from core PCE ending the year 2022 from 4.5 to 4.8. That would mean that the December core PCE reading would have to be a 0.7. We've never had a 0.7. The November one is going to be 0.1. They're just making up stuff to talk the market down.
Also to be clear, I mean, this is not a collective forecast, right? It's like an amalgamation of everyone's individual, belief about which way things are going. So I think, I personally believe they need to stop with the dot plot and the projections, because every time Powell goes up, they keep saying, well, you have to remember, this is all just like a collection of like every individual. So I'm like, why give it to us? Like, what's the point? You keep telling us to ignore it, but you keep releasing it. Right? Well, I think that see here, move along, but then you keep giving it to us.
Yeah, well, that's exactly what the Treasury market, what you just characterized as sort of laughing it off and blowing it off, is exactly what the Treasury market did. The equity market did not. The equity market
barked the equity market a few days to realize what's going on, but the Treasury market immediately just laughed in their face.
Yeah, the Treasury market, still, if you look at the Treasury's barely moved, and not in a significant way, and certainly relative to the moves that we saw in equities and the dollar. And the Treasury markets are, as everyone sort of understands, are the smart market. They're the ones that this is the market to really pay attention to. And there was some impact. But if you look at the Fed Fund futures, the expectation, it's still very much the concept is maybe 25 basis points at the next meeting in early February, and maybe another 25 after that, and then that's call it quits. It's like barely 5%,
and then it's time to start cutting.
And then cuts are priced in at the end of next year on the idea that we are going into and the Fed is tightening into a global recession. and that
which
really
all the data shows. I mean, we got pretty terrible global PMI readings overnight.
Yeah, I saw one quote that said that markets weren't, quote, didn't seem to be internalizing the nuances of Powell's comments. Like, is that what that is?
Well, Brai, I think they're targeting the S&P. I think they want stocks to go down, and that's what all the communication. They wanted to be able to slow the pace of tightening, but not have equities go up. So all of the projections and the communication was meant to drive stocks down. What do you think about that?
Well, no, I agree. I think it seems very weird. I feel like after every data point that seems somewhat okay, the market they think, it means the Fed's going to slow down their pace of tightening. And then Powell has to come out and reinforce that, no. We're doing this for a while. We're going to be high for a while. Like, don't take this as like, we're going to cut soon. But I've always viewed equity markets as like the dogs of the financial world, where it's like squirrel. Like that's the smallest thing they react to. Right. And it makes no sense why, because again, to your point, John, the treasury market, the smart kids in the room are like, no, like they say what they say and they mean what they say. But then I wonder though, how much of this is tied to like the machines now running things, and the machine can't process like nuance. And so it sees a data point and it's programmed to trade on a data point. So it just like how much of it is machine driven versus people driven?
I think that's a lot. So I don't really pay attention to the market reaction until like 3-4 days after the big event,
Yeah. And the equity market, we've seen this movie before. If you're looking at the chart of the S&P 500, the top part of basically the top of the downside channel and the 200-day moving average. I know technical, chart analysis for everyone is very boring. But, that's what a lot of the algos and, a lot of the traders sort of key off of. And again, the S&P 500 slammed its head up against the top of the downside channel and the 200-day moving average. It's having a very hard time punching out of that. These are the kinds of points, we're going into big options expiry today. These are the kinds of sort of technical and very much algo-driven trading patterns that you've seen take over. And so there is kind of a sense that maybe the equity market isn't the reaction really isn't as much as it sort of seems on its face to hawkish Fed, and has a lot more to do with just sort of trading dynamics.
Well, and I also feel, to go back to Brendan's question, I do feel like this is not your grandfather's equity market anymore, right? There are a lot more players who might not necessarily be the most, financially or finance savvy people who are pushing the buy or sell or whatever, and are not as like well versed in like passing Fed communications. And I think there's a lot of misreading that happens as a result of that.
Yeah, and part of the reason that I think that they're trying to drive down the stock market is to regain their credibility and break the market from the Fed put. They, basically from Greenspan's kind of started it, but especially accelerated after the global financial crisis when we started QE. That anytime stocks went down, the Fed was there to either cut rates or increase the bond buying. And on that I agree. I think that going forward we have a new dynamic in the markets where everything just doesn't go up. And we're seeing that now. We're seeing a disconnect between the treasury market and the equity market, where for 15, 20 years, really they've been connected. Actually, it really since since the early 80s they've been connected, right, John?
Yeah, absolutely. And I think I want to make sure that we're not dumping too much at the at the feet of the Fed, because when we look at the market reaction, honestly, like the worst reaction that we got was to the ECB, to the European Central Bank. And as sort of hawkish as the Fed tried to, the hawkish atmospherics, the impact on the bond market, which is really the bedrock kind of place that it would impact, didn't really move the needle. The European Central Bank, however, really did move the needle, and they are in a stagflationary disaster. And the European Central Bank is in the process of they've got a really tough job. So that's a challenge. They downshifted as well, but they sort of mirrored the Fed's very aggressive rhetoric. And boy, there was a major impact in the bond market because they also flagged that they'd be rolling back their asset purchase program, and that would start. They had kicked that can down the road to everybody's great relief at the prior meeting, but then announced that it would begin with a reduction in March. And what do you know? The Italian bond market cratered. And
I think this is
30 basis points in the 10-year. I mean, it's a horror show. And
QE in America is so different than QE in Europe, where when we go into risk off, actually everyone buys our bonds and the yields go down. When something bad happens in one of the less strong countries in Europe, their bond yields go up a lot. So their QE actually has a massive effect in terms of where the yields go. Brai, do you think they can handle, like Italy and Greece and Spain? Spain seems to be doing all right, but especially Italy. Can the ECB really back away from purchasing these bonds?
No, I don't. I mean, I think the problem that the ECB has, and to a lesser extent other central banks do, is the political aspect of it, right? Is that they're independent, they're meant to be fighting inflation, bringing inflation down. But the problem is that the markets still view these countries as individual countries.
Yeah.
They don't view them as part of the Euro area or the European Union. So they don't think, oh, it's one common, thing. You're all backed by the same. Like, no, they view Italy as Italy, Greece as Greece. And so it's you have a hard time convincing someone, oh no, our bonds are fine. They're like, no, I would charge you more to buy your stuff. You know what I mean? And so I think the political pressure is not there right now, probably because the hawks are finally getting their way. And who are among the hawks? Germany, Netherlands, etc. And so I think that might give the ECB some air cover, but I think eventually they might have to, for political reasons, adjust their approach a little bit.
Yeah, over-tightening by the Fed. Over-tightening by the Fed takes you into a deeper recession. Over-tightening by the ECB turns on the doomsday machine of bonds selling off and crushing local banks, which makes bonds sell off more, which crushes local banks, and Italy slides into an abyss of a sovereign debt and banking crisis nightmare, which we have seen before. And without support by the ECB, it's going to happen again. And so watch this space. It's not a pretty picture, and the ECB, I think, needs to risk manage their messaging and their policy mix with a lot more with a lot more caution.
No, and back to your question, Brendan, it's like, can they both raise rates to bring inflation down and also have a rescue program or some sort of support program buying, low-rated bonds? I don't know how you pull off both at the same time.
Yeah, but they might have to, because when we do QE, the whole point is to buy treasuries so that other investors invest in riskier things. That's like the whole point of it. In Europe, it's to make sure that the Italian yields don't go to 20%.
Yeah. I mean, essentially, it's incoherent from a monetary policy perspective. It's like driving with your foot on the brake and on the gas. But that's exactly what the ECB is going to have to do. And the faster they acknowledge that, the ECB is, they've learned a lot of lessons over the past decade plus in crisis fighting management. We've already seen, acknowledgement of reality that they can only go so far on this front, but it's a very fine line that they're going to have to walk.
Guys, thanks again for joining us as always. Thanks for listening to the Macrocast. I'm Jonathan Graffeo with Penta. Thanks to John, Brendan, and Brai for joining us. Have a great weekend, everybody.
Thank you for having me.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.